Every year you should take a very good look at your investment portfolio, and you have to rebalance that portfolio. You have to reallocate losing posts and you have to let your winners run. And you also have to make sure that your risk exposure is limited over time. I will be doing my reallocation now, and I will discuss where I will be investing over 2021. What's up everyone, my name is Joris, welcome back to my channel. 2020 has proven to be a very volatile year, and once again it has shown us the truth behind the old investor saying time in the market always beats timing the market. No one expected a 40% drop within 2 weeks in March 2020, one of the swiftest drops in the stock market history, followed by one of the fastest recoveries as well. Remember all the experts saying we'd have a I curve, an L curve, a W curve, a V curve, and all the other letters of the alphabet curve. It looked like everyone was clueless about what was really happening. 2020 has definitely proven that timing the market is not possible, not even for the experts. Then why should you, a small investor without access to all the financial information, be better than those professionals? For 16 years, the S&P Dow Jones has published a report called the S&P Indices versus Active Report, or SPIVA. This report has become the de facto scorekeeper for comparing traditionally active managed funds, managers who pick stock and market time based upon their belief that they can outguess the collective wisdom of markets, versus the passive investing, such as buying an index fund that simply tracks the S&P 500 in this case. In over 92% of all cases, active fund managers failed to beat the benchmark, the index, over the long term. Knowing this, and knowing that you will be investing for at least 10 to 20 years, would you really want to try to outperform the market yourself with limited access to financial information? I am pretty sure that your personal percentage will be even worse than the professional teams. Or would you rather invest no time at all and just ride the waves of the benchmark, also known as the index? Be lazy for once and let your investments grow over time. Don't get hyped up by the numerous posts of people who have made 50% return in 1 month, or that they have just invested in the new meme stock. These people run an extremely high risk, and if you don't set up a fail-safe system for yourself, one day you will lose it all. Again, be lazy, and don't be afraid to be so, and let your investments work for you instead of you working for your investments. And this is exactly why I'll stop investing in stocks, and this is why I'm investing half of my portfolio at least in the global allocated broad index fund. If you can't beat them, just join them and make them work for you. Before now, my portfolio's share in the global diversified fund was too small, it was too limited. Most of my investments were in single stocks. Now, after my first few changes, the global fund consists of 55% of my portfolio, and I have another 15% in specific sector trackers, a 4% in crypto, and 26% still in single stocks. The latter has to be lowered over time in favor of the global allocated fund. By the end of this year, I want to have a base portfolio of 70% in a global fund, 20% in sectoral trackers, 5% in crypto, and 5% in single stocks. And maybe, just maybe, I'll even transfer those last few stocks towards the global tracker and stop following the company news altogether. And here is my reasoning behind it. I know that I simply cannot outperform the whole market. That's why I am investing at least 70% of my portfolio in the market. As for my other investments, maybe I should start with the individual stocks. They are relics from the past, and I don't really want to sell them since they still have great potential. But once they reach a certain threshold in my mind, I will be selling them just to get rid of them and stop worrying about the financial news about those stocks. I'll transfer the money into a safer option. I simply cannot keep up with the company news, and I will say that I'm not knowledgeable enough to know where the stock prices will be going in the next few months. Especially not since not all information is public, and when it does get released, it's often too late. Apart from that, I like to follow current market trends. During the last few years, I noticed a lot of newer companies in green energy or clean energy are being set up. A lot of investors are starting to invest in those companies, and thus those prices are going up. This year I will probably be investing in clean energy, or at least I will be looking into it. Apart from that, I will also be looking into esports and private equity. I'm a big believer of private equity, by the way. Private equity companies are companies that are not listed on the stock exchange. They are privately held and most likely held by investment companies. Even in bad years of the economy, still money is being poured in those companies and they are able to grow even though the economy is doing bad. In most cases, when the economy is bad, we can still see that private equity is keeping their income secure because they keep getting funds by the investment managers. That's why, in my opinion, private equity in the long term should also be a part of your portfolio. By building this portfolio, I'm not actively trying to outperform the market. The majority of my investments are just following the markets for the long run. And this part of the portfolio will also be my nest egg for later in life. But aside from that, I'm also investing in several specific sectors that I think will be doing great in the next few years. But to limit the risk of exposure and diversification, I will be investing via ETFs, via trackers in those specific sectors. Most of those sector ETFs are very small. They only consist of 20 to 30 stocks, which in itself has a huge added risk. If one of these companies goes bankrupt, this will affect the ETF badly in percentage-wise, but it will also have a result on the performances of the companies within the sector, and thus it will have a double negative effect on the investment. But fortunately, the opposite is true as well. If one of the companies in that basket is performing extremely well, this will have a positive effect on the value of the ETF, but also it will have a big effect on its peers in the same sector. Following these market trends is slightly easier than picking specific stocks, but it still requires a lot of time and research. Market trends come and market trends go, so you really have to make sure that you stay up to date with the interests of investors, of big investors, as well as the small investors. Because those small ETFs don't have a lot of assets under management, so even the small ETF investor can have a small impact on the share price. If a lot of small investors start selling the ETF altogether, the price will go down at that point. And due to their risk, due to their volatility, you should really limit your exposure to these specific trends and keep your main focus on the global portfolio. I thank you for watching, and if you found this video helpful, please leave a like for the YouTube algorithm. It really helps my channel tremendously and it helps us share information with like-minded people. Also, don't forget to subscribe and hit the notification bell to be alerted when a new video comes out. If you want to see more of my videos, I have selected a few of them and you can watch them by clicking right here. Again, I thank you very much for watching and I will see you in the next one. Cheers!